Right now, something strange is happening in Bitcoin. While most retail investors are waiting for a clear signal, waiting for price confirmation, waiting for Twitter to tell them what to do, institutions are already positioning. They are not reacting to headlines. They are not chasing green candles. They are quietly building exposure while fear, confusion, and boredom keep retail on the sidelines. Let me ask you one important question before we begin. What if the biggest money in the world already knows where Bitcoin is heading, and retail is once again arriving late? If you want to understand how institutions really think about Bitcoin, not hype, not noise, but real strategy, make sure you subscribe to this channel, because this video could completely change how you see the market. Most retail investors look at Bitcoin as a trade. Institutions look at Bitcoin as a system. That single difference changes everything. Retail asks, is this the top or the bottom? Institutions ask, how does Bitcoin fit into global liquidity cycles, monetary policy, and long-term capital preservation? While retail is emotionally attached to short-term price movements, institutions are focused on structural trends that play out over years, not weeks. One of the biggest things institutions see in Bitcoin is monetary insurance. They don't see Bitcoin as a get-rich-quick asset. They see it as protection against currency debasement. Governments around the world continue to print money, increase debt, and dilute purchasing power. Institutions understand that fiat currencies are designed to lose value over time. Bitcoin, with its fixed supply and predictable issuance, offers something no fiat system can provide: mathematical scarcity. Retail often ignores this and focuses only on price volatility, missing the deeper purpose Bitcoin was created for. Institutions also understand Bitcoin cycles far better than retail. Retail investors often believe that price moves randomly or that every bull market will last forever. Institutions study historical cycles, halving events, liquidity conditions, and capital flows. They know that Bitcoin moves in phases: accumulation, expansion, euphoria, and contraction. Most retail investors only show up during the euphoria phase, when price is already extended and risk is highest. Institutions quietly accumulate during periods of boredom and fear, the exact moments retail loses interest. Another major advantage institutions have is their understanding of liquidity. Retail watches price. Institutions watch liquidity. Bitcoin doesn't move because of hype alone. It moves when liquidity enters the system. Institutions track central bank policies, interest rates, bond markets, and global risk appetite. When liquidity tightens, they reduce exposure. When liquidity expands, they increase it. Retail, on the other hand, often buys because a YouTuber said Bitcoin is pumping, without understanding what's actually fueling the move. Institutions also see Bitcoin as part of a portfolio strategy, not a single bet. Retail investors often go all in or all out emotionally. Institutions allocate a percentage. Even a small allocation to Bitcoin can dramatically improve risk-adjusted returns over time. That's why pension funds, hedge funds, and asset managers don't need Bitcoin to go to extreme prices to benefit. They only need it to outperform traditional assets on a risk-adjusted basis. Retail misses this because they are obsessed with moon targets instead of probability. One thing institutions deeply understand is volatility management. Retail sees volatility as danger. Institutions see volatility as opportunity. Sharp drops are not signals to panic. They are signals to analyze. Institutions use drawdowns to rebalance, hedge, or increase exposure at better prices. Retail often sells at the worst possible moment, transferring their Bitcoin directly into institutional hands. This transfer of wealth happens every cycle, quietly and repeatedly. Institutions also pay close attention to on-chain data, but they interpret it very differently from retail. Retail looks for simple signals: exchange inflows, whale wallets, or social sentiment spikes. Institutions look at long-term holder behavior, realized price, dormancy flows, and supply dynamics. They track whether Bitcoin is moving from weak hands to strong hands. When long-term holders are accumulating and selling pressure dries up, Institutions see opportunity, even if price looks boring. Another critical thing retail misses is how institutions view regulation. Retail often fears regulation, assuming it will kill Bitcoin. Institutions see regulation as validation. Clear rules make it safer for large pools of capital to enter. ETFs, custody solutions, and regulatory frameworks are not threats, they are bridges. Institutions understand that every step toward regulation brings Bitcoin closer to integration into the global financial system. Retail panic sells on regulatory headlines, while institutions prepare for increased adoption. Institutions also understand time preference far better than retail. Retail wants fast results. Institutions are patient. They are willing to wait years for a thesis to play out. Bitcoin rewards patience, not impulse. The biggest gains in Bitcoin history were captured by those who held through uncertainty, not those who traded every move. Retail often overtrades, overreacts, and underperforms because they cannot sit still. Another major difference is how institutions handle narratives. Retail follows narratives. Institutions use narratives. When the narrative is negative, institutions accumulate. When the narrative becomes euphoric, institutions distribute. Retail thinks narratives predict price, but institutions know narratives usually appear after the move has already started. By the time Bitcoin is on mainstream news, institutions are already managing exits or hedges. Institutions also view Bitcoin as a geopolitical asset. Retail rarely thinks about this. Bitcoin is neutral, borderless, and censorship-resistant. In a world of increasing geopolitical tension, capital controls, and sanctions, this matters. Institutions understand that Bitcoin's value is not just financial, it is strategic. It provides optionality in a world where traditional systems can fail or become restricted. Perhaps the biggest thing retail misses is discipline. Institutions follow rules. They have risk management frameworks, position sizing models, and exit strategies. Retail trades on emotion. Fear, greed, and hope drive decisions. Institutions remove emotion from the process. That's why they survive multiple cycles while most retail investors disappear after one. So what does all this mean for you? It means that if you want to think like institutions, you must stop reacting and start observing. Stop chasing price and start studying structure. Stop focusing on short-term noise and start understanding long-term forces. Bitcoin does not reward the loudest voices or the fastest traders. It rewards those who understand what it truly represents in the global financial system. Institutions are not smarter because they have secret information. They are smarter because they have better frameworks. And the good news is, those frameworks are available to anyone willing to learn, think independently, and remain patient. If you've made it this far, you're already ahead of most retail investors. And if you want more deep, institutional level crypto analysis like this, the kind most people never talk about, subscribe to the channel. Because the next cycle will not reward those who follow the crowd. It will reward those who understand what the crowd misses.